Looking ahead to 2026, the U.S. economy is expected to display characteristics of resilience, coexisting with imbalance under the combined influence of multiple variables, including inflationary pressures, slowing employment, policy shifts, and structural divergence. Under a neutral scenario, we forecast GDP growth around 2.3%. On one hand, private consumption, influenced by wage divergence, wealth effects, and tariff pass-through, is expected to show a K-shaped divergence trend, with attention needed on potential wealth effect drags from asset price declines. On the other hand, the start of the rate-cutting cycle and the continuation of proactive fiscal policy are set to boost investment as the restrictive effects of interest rates gradually diminish. Inventory, real estate, and corporate equipment investments are expected to see a phased recovery, with AI investment growth projected to moderate moderately under the neutral scenario. The labor market presents complex signals, with structural imbalances emerging. The supply-demand mismatch is becoming a long-term constraint. Regarding inflation, tariff costs are expected to gradually pass through from the production side to the consumer side, with rising core goods prices and sticky service prices anticipated to push up the inflation center in the first quarter. In this context, the Federal Reserve faces a more severe quadrilemma: the interplay of inflation rebound, slowing growth, liquidity risks, and independence policy pressures. Under the neutral scenario, assuming continued easing in tariff and geopolitical frictions and gradual advancement in AI commercialization, the Fed is expected to maintain a data-dependent, moderately accommodative policy, likely cutting rates twice by 50 basis points in total. Short-term U.S. Treasury yields are expected to decline, while long-term yields face constraints, continuing the bull steepening trend of the yield curve. Considering the combined effects of cyclical wage growth, policy impacts from tariffs and fiscal measures, and the ongoing wealth effect, private consumption in 2026 is forecasted to exhibit a K-shaped divergence, resilience among high-income groups, and cooling among low-income groups. Furthermore, given that labor market slowdown pressures and inflation pressures are expected to be greater in the first half of 2026 than in the second half, private consumption performance may show a weaker first half, stronger second half pattern. Under the neutral scenario, full-year private consumption growth is projected around 2.3%. Cyclical effect. The K-shaped divergence in wage growth is expected to gradually impact private consumption divergence. The overall health of U.S. household balance sheets remains sound. The household leverage ratio slightly declined from 69.4% in Q4 2024 to 68.3% in Q1 2025. The credit card delinquency rate edged down from 3.1% in Q4 2024 to 3% in Q3 2025. The ratio of revolving credit to disposable income slightly decreased from 5.8% in January to 5.7% in August. However, a K-shaped wage growth divergence is evident, with the slowdown most severe for low-income groups. While the U.S. average hourly earnings for non-farm payrolls increased to $36.7 hour in September 2025, year-over-year wage growth peaked in early 2023. By income group, as of August 2025, wage growth for the bottom 25% had slowed to 3.6%, down 0.8 percentage points from the beginning of the year, while wage growth for the top 25% remained at 4.7%, largely unchanged from the start of the year. Under the dominant narrative of AI and other technologies, the U.S. labor market overall faces further cooling pressure in 2026, and the K-shaped wage growth divergence is expected to increasingly influence private consumption performance. Currently, inflationary pressure from tariff policies is primarily absorbed at the import and production stages. It is expected to pass through to the consumer side in the first half of 2026, with a potentially larger impact on low-income group consumption. Upward price pressures have already appeared at the import and producer levels in the U.S., as seen in various upward pulses in the Import Price Index, End Producer Price Index, and Producer Price Index. However, pass-through to the retail side remains incomplete, with the Consumer Price Index, CPI, rising moderately, and inflation contributions from core goods most directly affected by tariffs, for example, appliances, not being significant. Based on historical transmission chains and the current inventory cycle, tariff pressures are expected to reach the retail sector starting in Q1 2026, becoming a significant upward force for CPI in the first half of the year. Rate cuts could further increase inflationary pressure, thereby suppressing consumption for low-income households during that period, while having a relatively smaller impact on high-income households. Fiscal policy is more favorable for the wealthy asset holders in the short term, while improvements for low-income households are relatively lagged. Short-term measures, including adjustments to estate taxes and state and local tax SALT deductions, and cuts to the top marginal tax rate, directly benefit high-income households and asset holders. For low-income households, they face simultaneous reductions in tax credits and key social welfare benefits in the short term. Yale University estimates an annual income reduction of about 2.9%, approximately $700, for the bottom 20% of households by income, while the transmission of increased corporate profits to employee wages is expected to be relatively lagged. The wealth effect strongly supports consumption for high-income households. The top 20% of U.S. households by income hold 87% of all stocks and mutual fund assets and 56% of real estate, with U.S. stocks continuing to hit new highs and real estate prices remaining elevated. Consumption willingness among high-income households is robust. In contrast, low-income households' core assets are primarily concentrated in human capital and cash deposits, making asset price increases less stimulative for their consumption. Supported by U.S. economic resilience and dual accommodative monetary and fiscal policies in 2026, U.S. asset prices are not expected to face conditions for a sharp decline. However, attention is needed on risks of asset price declines and their drag on the wealth effect due to inflation, disturbing the expected rate cut path or slower than expected AI commercialization progress. Currently, U.S. stock market valuations are at historical highs. Coupled with the market's shift in focus from technological vision to commercial returns for high-tech AI companies, this increases the risk of stock market adjustments. Simultaneously, U.S. real estate price gains are narrowing, with the median home price hovering around the $430,000 mark for a year. Rising housing inventory, months of supply for existing and new homes recovering to 4.5 and 7.4, and the potential unlocking of the rate lock-in effect, where homeowners with low pandemic-era mortgage rates are reluctant to move amid higher rates, also increase price adjustment percent pressure. Similar to real estate investment, the constraints of market interest rates on corporate investment are nearing an end. As of Q3 2025, the return on invested capital for S&P 500 companies rose 0.2 percentage points to 5.3%, already exceeding the interest rate for investment-grade corporate bonds, BBB rate, at 5.1%, with lower rates for A, AA, AAA grades. This implies corporate investment returns slightly exceed financing costs. Coupled with potential future corporate tax incentives, this is expected to encourage increased equipment investment. Also, in the second half of 2025, deregulatory policies in sectors like finance and energy were implemented. With midterm elections approaching in 2026, the Trump administration is expected to continue promoting further industry deregulation to support investment and economic growth. Under the neutral scenario, AI investment growth is expected to moderate moderately. Capital expenditure growth for the four major AI-related companies was substantial in the first three quarters of 2025, at 64.8%, 81.4%, and 73.2% year-over-year, respectively. However, hardware constraints in energy, for example, aging US, infrastructure, and gradually emerging power supply bottlenecks, cooling, and storage are becoming apparent. Additionally, prior computing power deployment needs digestion and optimization, leading to an expected moderate slowdown in AI investment growth in 2026. In extreme scenarios, if commercial application progress is hindered, or significant regulatory, security, or geopolitical risks materialize, AI investment growth could be dragged down. Conversely, if commercialization progress or technological iteration speed exceeds expectations, investment pace could accelerate. The U.S. labor market presents a series of complex and divergent economic signals. On one hand, the volatility of non-farm payroll data has increased significantly, with frequent large downward revisions weakening its forward-looking signal function. Before revisions, there was a notable scissors gap between the January-June NFP data and the ADP employment data reflecting private sector employment. However, substantial downward revisions by the Bureau of Labor Statistics reduced the average monthly job additions in the first half from 130,000 to 87,000, narrowing the NFP-ADP scissors gap. Cumulative NFP job additions in Q2 were 164,000, higher than the cumulative ADP increase of 66,000 jobs. On the other hand, mid-year became a significant inflection point for labor market data changes. Starting in June, NFP data underwent significant downward revisions, primarily due to systematic adjustments to government education sector employment. Concurrently, the 43-day federal government shutdown beginning in early October further disrupted the short-term rhythm of the labor market. The shutdown delayed government hiring, audit processes, and labor statistics work, negatively impacted business expectations and consumer confidence, and intensified market concerns about a slowdown in economic fundamentals. Additionally, disruptions in some public service operations indirectly affected hiring plans and temporary labor arrangements in the private sector, creating short-term statistical noise in employment data. Overall, these disturbances not only led to significant data revisions and signal deviations, but also highlight the need for increased attention to data revisibility and lag risks in the current phase. Looking ahead to 2026, signals from multiple levels indicate rising uncertainty in the U.S. labor market. We believe deep-seated structural imbalances will be a primary constraint, continuously pressuring employment recovery and supply-demand matching. Supply-demand gaps are gradually closing, but the labor force participation rate, LFPR, has not returned to pre-pandemic levels, with long-term structural bottlenecks persisting. The JOLTS vacancy-to-unemployed ratio has gradually declined from above 2 to 1 at its peak in July 2022 to about 0.98 1-inch August 2025, indicating a significant easing of employer tightness. Meanwhile, the year-over-year growth rate of average non-farm hourly earnings has fallen from its peak to below 4%, among the lowest levels since 2021, suggesting weakening wage-driven factors in the labor market, a marginal strengthening of employer bargaining power, and some industries reconsidering the sustainability of wage costs. The slow recovery of the LFPR also supports supply-demand balance and contributes to dragging down wage growth, but it has not fully returned to pre-pandemic levels. Long-term structural bottlenecks remain. According to the latest data released for August 2025, the LFPR rose to 62.7%, but remains below the pre-pandemic level of 63.4% in February 2020. Overall, we expect the Fed to continue cutting rates in 2026, but the policy pace will highly depend on the slope of inflation, decline, and marginal changes in the labor market. On one hand, although current inflation hasn't fully reached the end consumer, core goods prices remain affected by lagged tariff pass-through, and service price stickiness persists. The downward path of the inflation center may be less smooth than expected. On the other hand, while the labor market shows signs of weakness, no systemic deterioration has emerged, and the Fed is likely to remain cautious in its trade-off between employment and inflation. In this context, Fed policy guidance is expected to remain data-dependent and path-open, continuing to avoid explicit commitments on future easing magnitude to prevent markets from prematurely pricing in rate cut pace and causing financial conditions to loosen too quickly. For markets, a cut in the federal funds rate will lead to a rapid decline in short-term rates, but adjustments in long-term rates will remain constrained by widening fiscal deficits, increased treasury supply, and rising inflation expectations. A steepening U.S. Treasury yield curve will increase market sensitivity to duration and could also amplify asset price volatility. Meanwhile, market expectations for the rate cut path will exhibit characteristics of repeated revisions driven by data, with marginal changes in monthly inflation and employment data potentially triggering adjustments in interest rate futures pricing. Close attention is needed to the dynamic interplay between policy, implementation pace, and economic fundamentals. U.S. economic growth in 2026 is expected to retain some resilience, but the divergence in consumption and employment, structural inflationary pressures, and complex constraints on policy space will be key challenges. Regarding growth, under the neutral scenario, the U.S. economy is expected to exhibit slowing growth plus structural reshaping characteristics. Supported by policy backstops and asset prices, the overall economy should maintain some resilience, achieving around 2.3% GDP growth for the year. Consumption. The K-shaped trend intensifies, with low-income households facing greater inflation and income pressures, while high-income households show stronger consumption resilience supported by wealth effects. Investment, rate cuts, and policy support are expected to drive a phased recovery in inventory, real estate, and corporate investment. But AI investment may moderate due to resource bottlenecks and digestion of prior computing power deployment.